You've probably heard the buzz about the new Trump accounts, right? The idea? It sounds pretty compelling on the surface. The government helps you fund a retirement account for your kid or your grandkid. Gets to start growing right away. By the time they retire, the account could be worth millions of dollars. So, should you open one the moment they become available in July? In this video, I want to help you understand exactly what these accounts are, how they compare to different ways you might already be saving for your kids. And one thing that makes this decision a lot more nuanced than all those headlines are suggesting. Let's start with the basics here. A Trump account. It's essentially a modified version of a traditional IRA, but this is designed specifically for minors. Now, starting on July 4th, these accounts can be opened and funded from the year a child is born all the way through the year that they turn 17. Now, once they turn 18, the account becomes a regular traditional IRA, and it's going to follow all the standard IRA rules from that point forward. Now, the purpose is to give kids a head start on their retirement savings, and they do that by harnessing the power of compounding growth over the child's life, increasing their time horizon. The math here, it's genuinely impressive. If you invest $1,000 for an 18-year-old and it grows at 8% per year, by the time they're 70, that $1,000 has become roughly $55,000. But if you invest that same $1,000 at birth, by age 70, it grows to around $218,000. You have the same initial investment, the same growth rate, just more time. And that is the core appeal of the Trump accounts. The earlier you start, the more compounding can do the heavy lifting. But as you'll see, how the money gets taxed on the way out matters just as much, if not more, than the time it's invested. Now, there are three ways money can go into these Trump accounts. The first is a direct contribution. This is going to be after-tax money, so nobody gets a tax deduction here. Anyone can make this type of contribution for the child, and the combined limit in 2026 is $5,000 per year. Now, the second type of contribution is from an employer. This is going to be pre-tax money into the account. The employer can contribute to the parent's child's Trump account up to $2,500 per employee per year. So within that $5,000 combined limit, up to half can come from any employer. Now, the third is what the law calls a qualified general contribution. These are going to be contributions from the federal government, state and local governments, or charitable organizations. And these types of contributions, they don't qualify against that $5,000 limit. Now, the federal pilot program, that falls under this third type of contribution. For children born between 2025 and 2028, the U.S. government will deposit $1,000 into a Trump account as a one-time contribution. This is free money, but it is an opt-in program, which means you have to take action if you want to receive it. Let's do a quick example to show the possible growth. Mike and Sarah welcome their first grandbaby, Emma, early 2026. They elect into the pilot program. They get that $1,000 from the government, and they're going to commit to contributing a flat $5,000 contribution per year from Emma's birth through age 17. So 18 years of contributions for a total of $90,000 out of their own pockets. Now, the contribution limit for these Trump accounts will adjust upward for inflation over time, but we're just going to keep the math simple here. At an 8% annual growth rate, Emma's Trump account is going to be worth roughly $206,000 by her 18th birthday. Now, of that, only $90,000 is money that her grandparents have already paid tax on. So the other $116,000, which includes all of the investment growth and that initial $1,000 contribution from the government, will be taxed as ordinary income when Emma withdraws it. Okay, I want to take a step back here. I've gotten a lot of questions about using these new accounts as savings vehicles for grandchildren's college expenses. The most popular current option for that goal is called a 529 college savings plan. Now, Trump accounts versus 529 plans, it's a bit like comparing a hammer to a screwdriver. A 529 is designed for education costs. A Trump account is designed for retirement. Now, we'll come back to how 529s fit into the bigger picture in a minute. But for now, let's talk about the comparison that I think is actually a lot more interesting. Trump accounts work like traditional IRAs. The after-tax dollars that Emma's grandparents put in are her basis, and those will come out tax-free later. But everything else, the pilot contribution, any employer contributions, and all of the investment growth, that's all pre-tax. So if Emma leaves that $206,000 alone from age 18 until 59 and a half, 8% annual return, it grows to roughly $5.2 million. Now, of that, only $90,000 is her tax-free basis. More than 98% of the account will be taxed as ordinary income when she withdraws it. Now, if you're somebody with a large IRA or 401k balance, this might start to sound familiar. Trump accounts could create the next generation of that tax bomb headache. Now, there is another type of account that you can open for a minor called a custodial account. You may have heard these called UGMA accounts or UTMA accounts. These are regular taxable brokerage accounts. Now, they're owned by the child, but an adult or guardian manages them until the child reaches the age of majority. That's typically going to be 21, but it does depend on your state. Now, the standard knock against these taxable accounts is that they have tax drag. Every year, dividends and capital gains get taxed, which reduces the amount in the account that stays invested and gets to compound over time. But for minor children, there's a special set of rules here. It's called the kiddie tax. It creates a real advantage when examining these custodial accounts. Here's how the kiddie tax works. For a dependent child, investment income is taxed in 3 different buckets. The first, $1,350 of investment income in 2026 is completely tax-free. The next $1,350 is taxed at the child's own marginal rate. So for a child with no other income, that rate is usually 0%. Now from there, any investment income above the $2,700 is taxed at the parent's marginal rate. So if Mike and Sarah open a custodial account for Emma instead of a Trump account, and that account generates $2,700 or less in dividends and capital gains each year, Emma pays 0 tax on that income. Now for this example, I'm going to assume that the kiddie tax income threshold does adjust upward each year with inflation. Here's the strategy. Each year, as the account grows, Mike and Sarah can sell the positions that have appreciated, realize those gains up to the threshold, immediately buy right back into the market. This is called capital gains harvesting. And unlike loss harvesting, wash sale rules don't apply here because you're realizing a gain. You can sell and rebuy on the same day without problem. The money gets to stay invested, and Emma doesn't owe any tax. So let's compare the two accounts side by side. If Mike and Sarah, they want to make that same $5,000 contribution per year, but they're going to make it to a custodial account instead of a Trump account. They actively harvest gains up to the kiddie tax limit each year at age 18. Both accounts are still worth roughly $206,000. The difference here, inside the Trump account, only $90,000 is after-tax money. The custodial account, after 18 years of harvesting gains and dividends, Emma's basis grows to roughly $145,000. Now fast forward, when Emma turns 60, assuming no further contributions to either account, the same 8% annual growth rate. The Trump account is grown to about $5.2 million. The custodial account, after paying taxes on the dividends, all that tax drag along the way, has grown to $4.6 million pre-tax. Now, after taxes on withdrawals, let's assume 22% on the Trump account, 15% on the custodial account. The Trump account's worth $4.1 million after tax, and the custodial account comes in at roughly $4.3 million. So the taxable account actually comes out modestly ahead in after-tax terms, despite the tax drag along the way. Now the catch here, that custodial account will require a little more active management. Someone needs to be doing the gain harvesting each year. The Trump account, you get to be more hands-off. Contribute, let it grow. You don't have to think about it. Now, whether that trade-off makes sense for you and your family depends on how engaged you're willing to be, what tax bracket you're in, and where your child will end up in the future. Now, I think there's one more feature of the Trump accounts that deserves a little attention. Once Emma turns 18, she can convert some or all of her Trump account over to a Roth IRA. On the surface, this sounds like a pretty powerful planning move. A young person with little to no income can pay tax on the pre-tax portion of the account at a very low rate, move it into a Roth, let it grow completely tax-free for the next 40 years. There's two complexities to this outcome. The first, again, is the kiddie tax. Now, if Emma's still a dependent on her parents' tax return, that could be the case through age 23 if she's a full-time student. Then the taxable portion of the Roth conversion is taxed at her parents' rate, not hers. Depending on her parents' income level, the appeal of these conversions early can disappear pretty quickly. Now, the second is how she pays that tax. If Emma doesn't have the cash outside of the Trump account to cover the conversion tax bill, she has to take an early distribution to fund it. That early distribution comes with both income tax as well as a 10% early withdrawal penalty on any pre-tax portion. That's going to meaningfully reduce how much ultimately lands in that Roth account. Now, whether a Roth conversion strategy makes sense, it depends heavily on Emma's tax bracket at the time of conversion, whether she has to cover the tax bill or somebody's able to help her out, and how tax rates generally look in 20 or 30 years from now. That last part, that's not something someone can predict. We don't know if today's rates will be higher or lower by the time that Emma reaches the period where she can do the conversions. A conversion might look smart at the 22% rate available today, but it could look very different under a different tax environment. Now, what we can say is that done well with low income in the early working years and outside funds to pay the tax, a Roth conversion strategy here is probably going to provide the best outcome for the three scenarios we looked at. But done poorly, pulling from the account, paying penalties in a high tax year, it can actually be the worst outcome. Okay, so what's the bottom line? Trump accounts are not a scam. The free $1,000 from the government is genuinely free money for eligible families, and it's worth grabbing. If a grandparent or an employer in the future wants to contribute to the child's retirement, this new structure will make that easy. But the narrative that these accounts will make your child a millionaire with no effort in a way that no other account can match, it just doesn't hold up when you look at the after-tax picture. A 529 plan still wins on education funding. The $35,000 lifetime rollover to the Roth IRA gives that one a retirement component as well. So if college costs are the priority, that's probably still the first place to focus. A well-managed custodial account with an annual gain harvesting strategy can produce comparable or even slightly better outcomes after tax compared to the Trump accounts and IRAs. And they come with a major advantage: flexibility. The money in these custodial accounts isn't locked up for Emma until the age 59 and a half. She could use it to buy a home, start a business, handle any of the big life moments that happen well before retirement. And if she passes away before spending it, the unrealized gains in that account would get a step up in basis at death. That's a significant estate planning advantage for any of her future children. The Trump account's advantage is simplicity. You can contribute, you don't have to think about it, and the tax-deferred compounding, it'll do its job over 60 years. The trade-off, a very large pre-tax balance at the end with required minimum distributions and limited flexibility before retirement. Both approaches can work. The right one, like most things, depends on your family's tax situation. If you have a child born between 2025 and 2028, the one thing I'd encourage you to do right now is look into the $1,000 pilot program. It's opt-in. That means you have to take action to get it. These Trump accounts are available starting July 4th, 2026. There's no reason to leave free money on the table. Now, beyond that, how you save for your child or grandchild's future, that's a decision worth thinking through carefully, alongside your broader financial plan, not just a standalone product decision. Now, if you'd like to talk through what makes sense for your family, I'd love to have that conversation. There's a link below to schedule a free consultation. And if you found this video helpful, please subscribe. I put out content like this every week to help families make more informed and confident financial decisions. I'm Jordan Drinkhouse. I'll see you in the next one.